Hey, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is Wednesday, February 22nd, 2023, and this is Blockhead Traders Weekly. In this week's episode, I am joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at the 1% trades briefly that we've got cooking still. I put a 1% trade on this past week, a little bit of a mistake trade. And then we got just a couple of general comments with the market situation out there that we're going to run through with you guys. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. Hop in there, say hello to myself, a few of the other Blockhead traders. Love to hear what you're trading. Love to hear the type of content you want to hear about. Also, you can go to thetagang.com/sprocket888 and you can find all of my trades, the good, the bad, and the ugly. This is also available wherever you get your podcast, so you can listen to us on your commute or wherever you are headed in an audio-only format. But let's hop to this week's content, Viper. 1% trades. We got some still going, Viper. So let me pull up where we stand with our 1% trades. We currently got 3 open right now. One of them I just opened this week. That's BYND. So, we'll talk about that in a minute. We still got my $19 scratcher of City out there. That thing's coming up for expiration here, 3rd week of March. We're finally now into the big theta burn, and we're below our 55 strike, so we're starting to bleed off money on that one. So we're now down $9.50, or approximately 50% currently. And you have your AT&T wheel kind of going. I think your wheel expires this Friday, no?
Yeah, it does. It is February 24th expiration, so it'll be done by the time this goes out. But I decided that we'll save the deeper dive into the play until next week when we can really debrief it all. There have been a lot of learnings so far, which is kind of the whole point of this exercise. As you might recall, when we talked about it, I picked something intentionally on the lower end of buying power tie-up, so $1,900, and again, purpose and thought behind that was showing that even if you have a smaller account, but you've also accumulated your drip for a little while, this was the sort of thing that you could get into. But like I said, there have been some pretty big learning notes along the way. I think we kind of talked about one of them last week on the particular when I sold the put and how I definitely could have optimized that a lot more. And as it's playing out now, though, it's looking like it will probably expire worthless, which I'm not too sad about. And again, some of that we'll dive into next week. But basically, some more learnings. We're on a deeper dive into the price action analysis of the chart and wondering if 19 was actually a decent buy-in level or not. So stay tuned for that cliffhanger.
Moving on to my 1% trade that I talked a little bit about last week. It was looking at BYND. The volatility was just really elevated. I thought I would go ahead and put a put vertical in closer to Wednesday or Thursday of last week. I kind of got sidetracked and forgot about it. And then Monday, the markets were closed. And then on Tuesday, I was like, oh, shoot, I was going to put one of those trades on. And then I was like, well, doggone it. Earnings are this Thursday. So I said, well, I'll put 2 orders in. I was actually going to play 2 1% trades. I was going to put a put vertical in at around a 25 delta, and then I was going to do an iron condor. So the put vertical I was going to do like a month out, and then I was going to do an iron condor for earnings. Because the volatility for earnings this week, which comes out on Thursday of this week, was 360 some percent, where normally the volatility right now in BYND is around 150%, which is in the 75th percentile, like elevated. So just uber elevated for earnings. So I put in 2 orders and only one got filled. So that's my 1% trade. The order that got filled was an Iron Condor order that expires this Friday. So it's only good for 2 more days. I put this on Tuesday, and the idea here was to kind of replicate a 16 delta strangle, which is normally just a naked put and a naked call at the 16 delta strikes. That can carry a lot of buying power. That can carry a lot of risk because you're not protected on the upside or the downside. So I went ahead to keep with the 1% trades and cap those at $1. Which basically means I'm going to go out $1 on the strike each side so that my maximum risk is $100, and then I collect the premium off of that. So on Tuesday, that 16 delta was approximately a $13.50 on the put side and $22 on the call side. So I basically sold each of those. And then because I wanted to limit my exposure and risk, I went ahead and bought the calls that were $1 out from each of those strikes. So I bought the 1250 put and I bought the 23 call. What that effectively netted me was $28 in premium for $100 in buying power at roughly a 16 delta strike. So that is about a 28% upside on $100, so 28% return. And the idea here is that BYND is going to stay in a range and not pop too much off of earnings, which are actually tomorrow after the bell. Let's go ahead and visualize that looking at a chart. And so what I've got here is the daily candles of BYND. And the boxes that I have kind of called out here are green is profit. So actually this goes, up for forever and kind of down forever. So that's the range I'm really looking at. That is the 13.50 strike down here and a 22 strike out there. It's 28 cents off of there because I collected 28 cents. So it's actually 28 cents higher and 28 cents lower than those two strikes. And then the end of that bar chart right there is this Friday. So this thing is only good until the 24th of February. So we're sitting right here, hey diddle diddle, right in the middle. But don't let that fool you because earnings can be super explosive, especially given the volatility of the options contracts that are expiring this Friday, have a 360% volatility today. So they're looking for about a $3 potential move on that strike. So we'll see what happens after the bell tomorrow.
Kind of neat, your chart. You made a little level of that old the mobile game Flappy Bird from some years ago, where you got to flap the bird right.
Oh yeah,
right
that's what's going on. We're getting those candles right there through Flappy Bird.
No longer an Iron Condor; it's now a Flappy Bird.
Yes. Ooh, we should call this the Flappy Bird trade because that's effectively what you're doing. You're trying to get that Flappy Bird through the middle. In other news, Viper, I am having a little bit of deja vu these days. So if you go back into our back catalog, somewhere in the month of January of 22, I talked about a hedge. I put on a hedge, and basically a hedge is just a position that protects the opposite direction of your portfolio. So if your portfolio is largely long stocks, a hedge would basically be a trade that makes money if stocks were to crash. If you were thinking stocks were going to zero, a hedge would be something that where you think stocks are going up, right? It's a counter trade to what you currently have going. And back last January, means in 2022, I put a hedge on thinking, man, the market just seems like we're going to kind of dump here a little bit and just bad news. And so I put this hedge on and the market just rallied pretty hard. And I was like, oh, dang it. That was silly. And I took my hedge off to try to salvage some money. And it was just about a week or so later. And then, 2020, the rest of 2020 happened where it was just down. I mean, just big beat up and everything. And I kind of went through a lot of PTSD on that because I'm like, well, shoot, I put this hedge on. I took it off too early. I should have left it on and all this stuff. Well, fast forward to January of 2023. Again, the market was really rallying hard. Volatility was just uber low. And whenever volatility is low, buying options in my mind starts making sense because you're not paying for this extra premium that would normally come when volatility is very high, and premium just decays in time. So the less premium you're tacking on, the more value you might be able to get out of price movement. So I had been kind of experimenting with this channel thesis. Volatility was super low, and I decided, you know what? I'm going to buy some puts. And so I actually bought 4 futures contracts for the micro S&P futures. I bought them mid-January, so like January 15th, 16th, something in there, for expiration in March. So I went with the quarterlies. It was out a bit in time, because when you're buying options, you don't want your theta to decay so fast. So the further out that you buy, the slower theta burns until you get closer to expiration, and then it rapidly increases. Shortly after I bought them, the market started dropping, and I thought, holy smokes, I thought these puts might pay off, but dang, they're up big because volatility spiked. I just bought them. So it was like just great. But I said, nope, this is a hedge. We could really be going further down. Turns out we did not. We went up into just a monster rocket rally from there, which is fine because my portfolio was also largely long. And so the hedge did exactly what it did. I was sleeping fine when the market was falling. My long positions were losing, but this hedge was picking up value, exactly what it's supposed to do. I'm going to switch over here to this chart to kind of show you. I bought my puts right here in this range. And this drop here was that first drop that I just talked about. And then we went on this big rally up. Now my strike is the 4,000 strike. So S&P at the 4,000 level, that is where my put is at. So below 4,000, my put is in the money. Above 4,000, and I'm out of the money. So deja vu all over again, because we rally, and I said, I'm holding on. Nope, this hedge is going to do its job. And now recently we have dropped quite a bit from Tuesday and today. We are down a good bit now, right at the money now, 4,000. And I am at a dilemma. And this is that trading psychology that we talk about where it just kind of eats at you, because part of me says I can get out and minimize my loss on this hedge, or I can stay in. And if the market rallies from here, my hedge is a complete loser and I didn't minimize my loss, which was my original plan. I do want to call out that I did have a plan, and that plan was to keep that hedge on until we dumped well into the downside, then sell it off for a profit to go ahead and lock in those gains from that sink, and then let it rally back up and my longs will take over. So stick to the plan. That was the plan. But if you're familiar with some of the charting stuff that I've been experimenting so far, it's with channels. And specifically, we did a trade on oil. And oil, I bought some puts at the top of the channel. Volatility was low. Oil was, in my theory, going back down. Oil started to drop. Then oil broke out of the channel, rallied, broke out of the channel, just like the S&P broke out of this channel that I have marked right here. And we talked about how my thesis on channels are, when you break out of the channel, you're going to come retest the top of that channel, and you're going to reject off of that, or you'll fall back into the channel. But it's a decision point. If you reject off the top of that channel, a new channel will be forming. And we specifically did an episode where I said, Viper, my thesis is blown. We have broken out of the channel. We're retracing to the channel. I can get out of oil right now. And in that case, I could actually make money and turn, because I, sold stuff there. But anyway, and I said, I'm going to stay in it. And I stayed in oil, and oil bounced off that channel, rallied up, and that was a full loser. Here we are. Breaking out of the channel, tracing back to the top of the channel, and I am at a crossroads, because part of me says this is a hedge. It's not meant to make you money. although minimizing my losses is something I'm interested in doing. And then I have this other thing that says, no, you break out of the channel, you're going higher. I don't know, Viper. It's a dilemma in my brain.
I mean, where's the line between, I want to minimize my losses and the purpose of the insurance policy? What's the worst case scenario of the insurance policy?
Yeah, the worst case scenario in the insurance policy is you don't use it and you lost every penny you paid for it. Which, by the way, the original plan was my plan. When I entered that hedge was there to be your insurance policy come rain or shine. So going into that hedge, that full loser, 100% loser was the original exit.
Yeah. So it sounds to me like it is the emotional psychology piece that we talk about all the time, comes up in many, many different ways. But I mean, the play started with this money. The moment you push that button, this money is gone. I've paid for this insurance policy. Things get emotional when the siren song starts singing of, hey, maybe you don't have to.
That's what's going on here. It's just, you have this plan and you're just like, oh, I'm going to get clever. I'm going to get, and that's what's going through my brain. And that's what happened last year when I took the hedge off early. I thought, oh, I'm going to be clever. I'm going to take this off and I'm going to save some money and things are going to be wonderful. And that didn't work out. And we're here again.
Yep. Well, I don't know that I'm going to help or hurt the cause, but I have also been keeping an eye on the S&P here. So I guess first I'll start with just a couple thoughts as far as what I see the chart doing, where I see invalidations of not bouncing off that channel, so to speak. So if we take a look, these are levels that I've charted out. I've tried to, I'm not going to go into why I drew all of them, but I tried to at least anchor where they came from. So looking at the chart, you can see this was a previous low on the swing down. This white one down here was a low swing failure that put in a new low. So you don't want to lose that. And you can see as the chart played out, it's doing the right things in the current trend that it needs to do to get higher. So for example, off this white level here at 37.89, we kind of came up, we gained it, we slipped it, we regained it and confirmed it. Had this chop over here that refused to let it go, found plenty of support to then go put in a higher high. Putting in that higher high, we actually gained what I think is a pretty critical range here from 40.87-ish to 41.13-ish. And currently, obviously, we've slipped that range. So to me, I don't know. I mean, we certainly don't have any confirmation of trend is down. We're still within I guess this is sort of a potentially new channel if I try to draw correlations to the chart you showed. But we're doing the right things coming off of this low over here. And that's kind of where I anchor everything to, is what was the most recent low and what have we done since then. So since then, we've gained and held this level. So we absolutely don't really want to see that again. So to me, this critical range up here is significant enough that I didn't expect it to be an easy gain and easy grab of support, especially in a market that's down so bad. I don't think we're anywhere near parabolic conditions where things are just going to always go perfect. But I kind of equate it a little bit, not on the same scale, but just kind of like what potentially happened here on the previous important yellow level, 3,900 to 3,920-ish, where obviously we gained it, and we messed around a little bit up here. The important thing about how we messed around was we put in local highs, a new local high before failing. This last one here failed to put in a new higher high, and we came off of that and we slipped the range, only to confirm support at the level below and then go back and get it and keep marching up. So to me, it at least for now feels reminiscent of that move. We gained this critical range. We messed around a little bit. We put in a higher high, which was the important thing. We failed on this little swing here. We failed to put in a higher high, so micro trend is down, and sure enough, we slipped the range back down. So not trying to say history will repeat itself, but what we did previously when that happened was we went and confirmed support at the range below. And so if that is the case, my eyes are on 3920. We'll say 3920 to 39, maybe 3940, but I'm kind of drawn more to 3920. Nonetheless, whatever that range is, everything's telling me we're going to go down there and test for support. Whether we confirm or not, the time will be the judge of that. But it feels like a similar move to what we had before. We did what we needed to do. Now let's go back down, retrace a little bit, confirm or deny support, and then let's go get back up. So that does mean there's more downside. No, stop. That does not mean that does not mean there's more downside. That means I am anticipating more downside. We could wake up tomorrow and gap to 4,200. Who knows? But that's at least the read I see. So I don't know. I mean, that feels a little in line with kind of what you're thinking, but I don't know how much. So if let's just say we do go down to 3920, I mean, that's going to make you feel a little better not taking the hedge off, right?
Yeah, oh, absolutely. I get down to 3920 and my hedge would be green. It would be a range where I could sell it potentially if we confirm that support like you're mentioning and we come off of that. That might be a good signal to close the hedge because we are kind of in a little bit of a more of an upswing. And the reason I would consider closing it is because we're getting close to the end of the road for the hedge. So, the theta burn's really going to be there. Third week in March, it's done.
Yeah. And this definitely goes back to like we keep saying and will keep saying about options and all the different variables. First and foremost, yes, the simple answer is the play was designed to throw away that money for insurance purposes. However, as much as we just decried that, don't get emotional and whatnot, like there's still opportunities. And I think it's important to decipher, to anchor those opportunities into something fundamental. So I completely agree with what you said. Like taking it off right now, probably not a great idea because there's nothing fundamental that says like, oh, yep, you called it. It's right here. This is knife catching territory. However, if we get to some more firm confirmation that's based more in a fundamental technical analysis or price action, and we're clearly coming off of that, that would, to me, to use terms that we try to standardize around, that would be invalidation of the insurance policy. Right now, micro trend is down. We're retracing. That's literally the thesis for the insurance policy. So, if I were looking for an opportunity to pull it off early, I would anchor to invalidation of the insurance policy. And I think some form of confirmation of support kind of puts you there.
Yep, I think that's a fine way to look at it. I'm going to hold tight anyway, just see how it shakes out. But maybe this will be another one of those videos where we're like, yeah, remember that oil thing? Remember that thing? Yeah. Anyway, this is the learning game that is never ending.
Yeah. So the last thing I want to talk about on the S&P here is, obviously the wheel is still turning on my T play. I don't have another 1% play yet. Hopefully I'll scope something out for next week. But the other thing I'm doing that I have been doing for months and months and months, which is something I potentially encourage people to experiment with or give some thought to, which is my whole DCAing into the two ETF funds that I mentioned, VTI and VOO. VTI being the total market index fund, VOO being the S&P index market fund. And this is meant for long term. That's like, I mean, we talk about trading on the show. DCA isn't really something we talk about because that's more of a very long term tactic of the whole idea that time in the market beats timing the market. Trading is a lot different, where you are trying to time swings and whatnot. So I have been doing some DCAing and regularly watching the S&P here, because I do still want those DCAs to be at a reasonable price. I mean, you can, if you're thinking, 10-year time frame or something, timing a swing doesn't really affect that much over that long of a period. However, I have that price action trade mentality in my head that I just want to squeeze the last bit of efficiency out of the buys. So, for example, as we were approaching this 4,100 range here, I held off. I was like, no, I want to see when we're coming up. We've obviously rejected this range basically 3 times in the past. So coming up on it again, I didn't feel like that was where I wanted to be buying anything. I wanted to see what happened if we got rejected off of it, etc. So we gained and we came back down and gave it some tests here. I did a very small DCA when we were up here, and this was just, true to the spirit of, nope, it's time, I should buy. I didn't want to buy the swing up, and so I tried to buy as close to this 4087 lower range here. Just again, if we bounced it and got some crazy support off of it, at least that was a good entry. But I also made it small because of everything I just said about the move around this range that looks like we're shaping up to have. But I didn't want to go heavy on it or anything like that and then immediately be underwater on that. So that was a smaller DCA up there. And then as we slipped the level and started falling, now things are feeling a lot better. And actually just today, because we're now halfway down through this range, I figured that was a good opportunity to buy more. And because it's still early, my average price, we actually dipped below my cost basis. And so to me, as far as that mentality of getting a better price efficiency, dipping below the cost basis is much more open season of making some of those DCAs. So not a significant play or anything like that, but I just wanted to call that out because based on all of that analysis I just said on this chart and this pullback here, this wasn't a large DCA, but it was larger than what I did up top. And then sure enough, if we get down here to 320 and show signs of confirming support, I do plan to make another buy there. But like I said, that's overcomplicating the concept of dollar cost averaging into something. And some of that is just, I mean, everything fits your personality. And so my personality is just wanting to get that, feel that efficiency, or at least attempt it, whether or not it actually plays out.
All right. Well, that brings us to the end of this week's episode. 1% plays are out there chugging away. We'll see how they turn up. We'll do our retrospections on them, take you through our lessons learned. Maybe you'll learn something along the way. And just recalling out this week that trading mentality is nagging at you all the time. It doesn't matter how prepared you are. It creeps up in every way, shape, or form. Even for me, where it just is just tugging on you, saying, "Oh, you could get tricky here. You could get smarter." And it's a constant battle, whether you're up or down. It always messes with your head and plays with your kind of mindset. And so just it's real. Just talking through it here. so that, you don't feel like you're, oh, what's wrong with me? Like, this is just something you have to deal with and something you got to be prepared to be there and work through. A lot of stuff going on in the markets, volatility coming back, a lot of Fed talk about, rates getting even higher than they were regionally forecasted with the meeting minutes that came out today. Sure to bring good price action along the way. There's just so much uncertainty, it seems, these days. Lots of good market action to trade. So good luck out there. And remember, think outside the block.